right, everyone, welcome back. We are pleased to welcome Oliver Velez. Oliver was our inaugural keynote speaker from the very first Traders Expo. He's an international best-selling author, world-renowned trader, entrepreneur. He is one of the world's most respected and celebrated traders of all time. The Dow Jones dubbed him the Messiah of trading, and today in 2020, he continues to be defined as one of the most influential trading leaders of his generation. Oliver, always a pleasure to speak with you. The floor is all yours, sir.
Fantastic. Thank you. Thank you once again for having me. And thank you, traders. Thank you for for some of you, thank you for many years of trust, faith, support, and loyalty to my work. My name is Oliver Velez. As the speaker just mentioned, I've been in this industry for almost 40 years. We're coming on almost 39 years of total trading on my part, and 33 of those years as a professional. In 1994, I branched off on my own, which was a scary step. After a very successful career on Wall Street, I branched out on my own to go into the professional trading space, to train traders, to have a trading team of myself, of my own. And that led to a variety of wonderful things that have happened in my life. And I've been able to, as a result of that step, not only speak to traders throughout the world over the past 3 decades, 26 years to be exact. I've managed to build one of the largest trading organizations in the industry, if not the entire world. Right now, I have over 10,000 individuals that are in my trading programs from over 92 different countries. Many of these traders actually trade my own capital. And today, we'll be talking about one of those topics that I'm constantly on top of my traders about, which is protecting the money. Today's talk is specifically entitled How to Protect Yourself from Loss. And this is something I spend a great deal of time with my traders. And while it's impossible for me to be complete in terms of how I teach my traders how to protect themselves from loss, but I am going to pull out one of the major gems that I believe forms the foundation for keeping your losses small. Okay. So we're not going to spend a lot of time on introductory things, but I do want you to follow me on my YouTube channel, Oliver Velez Trading. It is one of the fastest growing trading YouTube channels on YouTube. Um, I spend a great deal of time every single day to make sure that 365 days a year, you receive something that has the potential of raising your level of market sophistication. Obviously, you know it's absolutely free and the content is extraordinarily valuable if you have interest in trading the markets actively. So Oliver Velez Trading, make sure you subscribe, make sure you hit the bell in the upper right-hand corner and select all so that every single day you never miss the valuable piece of content I have for you on the topic of trading the market successfully and professionally. Okay. Um, Last item before we delve into the material, I am having my last mega free event this upcoming Saturday at 10:30 Eastern time. I believe it is. No, it's 9:30 Eastern time. Sorry about that. This is my last one of the year. These are the largest events in the trading industry. We currently have over 27,000 registered traders throughout the world logging on to this event on Saturday. It is likely to be much larger by then, but I don't want you to miss this one. It is going to be the very best one by far. That is my promise to you. Just give me 2.5 hours of your time, and your life will never be the same as a trader. Okay? I promise you that. So Saturday, 9:30 Eastern time. All you have to do is go to ifundtraders.com to register. Okay. Now, let's get to the topic today, how to protect yourself from loss. Now, before I delve into what we need to do this, I want to clarify what I mean by loss. It is impossible to eliminate loss from market play. That is whether you are a day trader or whether you are an investor. Okay. Loss is a permanent reality for all speculators, all market participants. So when I say how to protect yourself from loss, what exactly am I meaning? What exactly am I saying? I'm saying this, that when you define what is an acceptable risk, I'm going to call it loss for lack of a better phrase, lack of a better word, but when you define a specific amount that you're willing to risk, that is not the loss I'm talking about. Loss is one penny beyond your acceptable amount. As an example, if you say, I don't want to lose more than $300 on this trade, $300 or less is not a loss. That was an acceptable part of your plan. I am not talking about the acceptable part of your plan. I am talking about the penny beyond, any amount of money beyond what you have defined as an acceptable risk for this potential play, the potential reward I'll get from this play. Anything beyond that amount is loss. Okay. So in the world of trading, we call our acceptable loss amount stops. So anything beyond your stop is a loss. Anything within your stop is the plan. So the plan, the acceptable loss, which is a component of your plan, that is not a loss. And you can't look at stopping out or taking your accepted loss, the loss that you defined as acceptable in the beginning, you can't interpret that as loss. Okay, very important. And it's important for your psychological health as well. Whenever you take your acceptable loss, you are doing the right thing. You should be rewarded for that. All right. You should pat yourself on the back for that. That is adhering to your plan. What I'm talking about is preventing yourself from going beyond the loss. Now, beyond your acceptable loss. Now, what are the specific items that we need today for me to delve deeply into this topic? We're going to need a candlestick chart. That's item number one. Many of you know that I am a technical trader in my approach to the markets. I'm not a fundamental trader. I do look at fundamentals, but my decisions are based on the technical reality that's in my face at the current moment. I use candlestick charts for that. Now, the time frame we're going to be looking at is short-term time frames, but what I'm teaching you is applicable across all time frames. So whatever time frame you are comfortable with, you can apply what I'm going to talk about with you today. We're going to need a 20-period simple moving average, a 200 simple moving average. And I'm going to talk today a little bit about three primary entry bars I teach my traders. So we're going to need to know how to enter these plays. There are three entry bars. E stands for elephant, T stands for tail bars, and NRB stands for narrow range bar entries. Okay. Elephant entries, tail entries, narrow range bar entries. We'll talk about those. And then we'll talk about what I generally term as the color change play. Okay. I should have play there, the color change play. So we need these five things, and you're going to understand these five things by the time I finish with this topic today. Okay, so why don't we do this? Why don't we go to some charts here today? Now, what I'm going to do is, yeah, I think that's fine. All right, this is my trading platform, and I want to show you here that I have on the left-hand side, let's take this watch list. I have a watch list on the left-hand side. Now I can sort this watch list on the left-hand side here. Let me just make sure you see where I'm pointing to here. I can sort this watch list or list of stocks here all the way to the left here. See, I can sort that list by symbol, up and ascending and descending, last price, ascending and descending. And I can do percent change on the day. So why don't we do percent change on the day? So I'm going to take percent change on the day, take this list and sort it by the stock that had the greatest percentage move to the upside, all the way down to the stocks that had the lowest, the had a negative percentage move to the downside. Okay. Now, why don't we just go down the list for a little bit here? We'll take Roku as our first play or our first stock. I'm going to go back to the beginning of today. Now, what you're looking at is a 2-minute chart. My traders are encouraged to do most of their short-term trading on a 2-minute chart. So every bar you see represents 2 minutes of trading. Okay. And I want you to take a look at the first bar of Roku's trading today. This is the first bar. This is what I would call an elephant bar, an elongated fat green bar. You can have a red elephant bar too, or a bear elephant bar, which would be a fat, long, solid, elongated red bar. Okay, but here we have an elephant bar. I want you to take note that we've got 2 moving averages on the chart as well. We've got the 20 period moving average, which is the blue line, and we have the 200 period moving average, which is the red line. Okay. Now, when the 20 period moving average is rising above the 200, my traders are taught that their bias should be to the upside. Okay. So they should be looking for green elephant bars to play. They should also be looking for what I call bottoming tail bars to play. So here's an elephant bar. I've just drawn for you the picture of what a bottoming tail bar might look like. And you can have small ones or relatively long ones as well. Here's a bottoming tail bar. You see the tail at the bottom. Here's a little mini bottoming tail bar, or one might consider that a narrow range bar. Here is a narrow range bar. So remember those 3 bar types that I want you to be able to identify. I want you to be able to identify elephants. I want you to be able to identify bottoming tail bars, topping tail bars in reverse, but right now bottoming tail bars. And I want you to be able to pull out little tiny narrow range bars, very small bars. Okay, these are the 3 bar types predominantly, and not the only ones, that I teach my traders to identify. Now, when either of these happen, we're looking to buy into the bar or slightly above the high of the bar. So an elephant bar, we're looking to buy into the elephant bar toward the end of that bar's formation. We're looking to buy into the bottoming tail bar or slightly above the high of the bottoming tail bar. And the narrow range bars, we're looking to buy into the next bar that moves above the high of the narrow range bar. So one of the easiest ways is just to buy 1 penny above each one of the 3 types of bars. Okay. Now, we have the 3 bar types that we're going to focus on. We know when the 20 period moving average is rising above the 200 period moving average, we know that these 3 bar types we're going to use to buy, not short, not sell, but buy. Okay. Now, how do you take this simplified approach to making money off of the 2-minute chart? How do you prevent yourself from loss? And it's very simple. What I teach my traders is to not lose the reason for your trade. One reason is the elephant bar. Another reason is the tail bar. The third reason is the narrow range bar. So if we buy this elephant bar, we can't lose, we can't allow our stock to lose more than the elephant bar. Our stop out is just 1 penny below that elephant bar. Once the market removes your reason, these are the 3 reasons for our entries: elephants, tails, now range bars. We immediately eliminate the trade. So in essence, traders, your loss for every trade is going to be limited to one bar. It's going to be limited to the elephant bar, maximum loss, or your loss is going to be limited to the bottoming tail bar, one bar, or your loss is going to be limited to the narrow range bar, one bar. Now, note, these three bar types are usually different sizes. So that means you're going to have usually three different sizes of loss. Okay. So your elephant bars will be slightly larger typically if and when you lose. Your tail bars will come in second and be largely the second largest loss of the three, and your narrow range bar losses will be the small. But it is the mixture of these that will ultimately give you an average loss per trade. Now, because elephant bars typically have the slightly larger loss, many traders trade those smaller in size. Because the narrow range bar loss tends to be smaller, they tend to play the narrow range bar setups with greater size, more shares, less shares on elephant bars, slightly more shares on tail bars, and maximum shares on narrow range bars. I hope you understand that. But listen to me carefully. If you can limit your loss to one bar, be it an elephant, tail bar, narrow range bar, if you can get into the habit of every time you lose, you limit your loss to one bar, when you win, traders, you will win like this: many bars. When you lose one bar, you'll win 8 bars. When you'll lose every time you lose, you'll lose one bar. But when you win, you might win 4 bars. You'll lose one bar, but you might win 20 bars. You'll lose one bar, but you might win 6 bars. You might win 14 bars. You might win 10 bars. You might win 2 bars. But every single time you take a loss, it's going to be limited to one bar, understanding that this one bar's loss is not going to be set in stone as a set amount. It depends on the size of the bar. Now, if your bar is too long for comfort, that's not your trade. Wait for a bar that is your trade. For as an example, if we continue with the Roku example, take a look at this elephant bar. Fat, solid, perfect green bar. That is an elephant bar. That's not a little green bar. That's an elephant bar. Okay. If you buy into this elephant bar right toward the end of that bar's formation, right in the last 10 or 15 seconds of that 2-minute bar, boom, you enter. You're going to protect yourself under the low of that elephant bar. So in essence, you're risking this little piece there. You see, if you buy this right above the high of this narrow range bar, you're risking the narrow range bar. Only risk one bar. And in this case, your risk is extraordinarily small. If you're buying 1 penny above the high of the bottoming tail bar here, you're risking the length of the bottoming tail bar. But look at the potential reward. Now, this is the formula that I'm constantly putting in the faces of my traders. I call it the snowman approach to loss. Why do I call it the snowman? Because your win-loss ratio should actually look like a snowman. Let's quickly draw that very quickly. I have trading kids, so I'm used to doing this. All right. Now, you want the body of the snowman to be profits. These are profits. You want the head of your snowman to be the losses. Now, how many of these heads can fit in the snowman's fat body? Many. So if we take this concept like this, and we say, this is the snowman's head. This is an upside down snowman. That's the loss. But look at the potential gain that could have been had. And so how many of these heads fits inside of that body? Let me tell you this, traders. If you can produce the snowman for the vast majority of your trades, and I'm teaching you how to do this, you will stay in this business forever. And it will be difficult statistically for you not to gradually become more and more profitable and more consistent, because the heads of your trades, the losses of your trades will forever be limited to one bar. And then the market will take care of the rest. You see, listen to me carefully. Many people have this game upside down. They think their business, their job, their responsibility is to go after the gains. That is wrong. Gains are the market's responsibility. Profits are your stock's responsibility, or whatever financial instrument you trade. Your responsibility is the loss. You see, you can't make Roku go up in price. All you can do is pray, right? So you have no input, no value in terms of the stock going up, but the stock can't stop itself. Roku can't stop itself from going down. Only you can stop the game. Only you can halt the action. Only you can cut the trade. So, in a sense, this is a partnership between you and your trade, you and your stock, or you and the item that you trade. The item that you trade's responsibility is to go up after you buy it. Your responsibility is to cut the game, to stop the game if the stock does not do its responsibility. And so you both have a responsibility. And so most people are focused on how do I get more wins, when you should be focused on how do you create the snowman head? How do you limit your losses to one bar at a time? Now, look, let's take a look at a few others here. How do you limit your losses forever? This is not something you do for a while and stop. Forever, traders. Forever. Let's go to the next item on the list. Remember, I told you that there was the elephant bar, right? That I want you to look for. That's an elephant bar. Okay. There's the bottoming tail bar. There's the bottoming tail bar. I want you to look for. Okay. And then there's the narrow range bar play. Okay. Let's take here's the little tiny narrow range bar. And then there's the color change play. The color change play. That was the fifth item, right? Well, a color change play is simple. It is a red bar that's taken out by a green bar. So we were red, and boom, a green bar takes out the high of a red bar. That's the color change I'm looking for. So let me just isolate a few of the color changes. Here's red, boom, taken out by green. Okay, here's red, boom, taken out by green, right? Okay, here's red, boom, taken out by green, right? Okay, good. We've got it. Now we can go back. Let's see. I'm going to do this here. Let's take this period here, this morning, and square. Okay. Now take a look at this color change. Red, boom, green takes out the red. Now, how do you prevent yourself from losing more than the snowman's head? The green bar taking out the red is the reason for your trade. The red is not the reason. The green bar that is taking out the high of the red bar is your reason. So your protective stop must be under your reason. Never lose more than your reason. So this is your risk. Now look at the potential reward. And there's your snowman. Okay. I had a trader this morning in Square that took the color change in the opposite direction. Let me show you that. So this trader took this green bar. See the green? When this red eliminated the low of the green, okay, this trader took the play. Boom! Enter short. Now, the green bar is not the reason for the trade. It is the red bar that is eliminating the low of the green bar that is the reason. So enter, boom. The reason, the top of the reason is the stop, and this is the head of the trade, the head of the snowman. And look at the potential reward. And so we want to snowman our trades left and right. And the easiest way to do this is to limit every single trade you take to one bar. The very bar usually that you're entering into. It's not always, but usually it's the bar that you're entering into. Let's continue with Square here. Let's say you want to do this color change. You see? Green. 5 minutes?
5 minutes.
All right, good. Thank you so much. All right. Green. The green bar is not your reason for the trade. It is the red bar that eliminates the green. You enter on the short side, boom, that's the color game in the opposite direction. Your stop can be above the reason for your trade, and even this potential gain is a snowman. Now, let's continue more. Look at, now we're on the support of this beautiful 200 period moving average. I can't talk much about the 200 period moving average. I got less than 5 minutes, but it's usually powerful support. Like, look here, boing. Okay. Now, boing. You see? Okay. Now, look at what we're starting to get on the 200 period moving average. Uh-oh. Look at this little tiny narrow bar. Look at what follows the narrow bar, an elephant bar. So whether you took the narrow range bar play, which is right above the little bar, don't lose more than the little bar, and look at the whole potential gain here. Wow. Okay. If you miss the little bar and you buy into the elephant bar, that's a play too. Elephants are plays. You buy into the elephant bar, don't lose the elephant bar. And this is still your potential play. Okay? And we already came over here with the color change. Here's another color change. Boom! Don't lose more than your entry bar. And even this still is a snowman. So here is the key. If you can limit yourself to losing only one bar for every trade, no matter what time frame you trade, I promise you, traders, your losses will statistically be so small in comparison to your wins if you let your wins flourish. That's the 64,000. That's the key. You got to let your wins flourish. But if you can let your wins flourish, your losses are guaranteed to be much smaller than your average winning trade. If you are playing with the moving averages, if you are largely playing above the 200, you're buying below the 200, you're going the opposite way. Not all the time, but generally speaking. So limit those losses to one bar, traders, and you will be in this business forever. Now, let's not forget, I don't want you to forget, traders, that I will be holding a very special event this upcoming Saturday. I need you to be there. iFundTraders.com. Register absolutely free. All I need is 2.5 hours of your time. We will be able to spend a lot more time delving into the very nitty gritty and the nuances of proper trading. My last event of the year. Be there. Thank you very much. Money Show. Thank you for having me once again. I love you guys.
All right, Oliver, another fantastic presentation. Always a pleasure to hear you
Thank you.
speak. So we will talk to you very shortly. Have a great evening.
Fantastic. Thank you. You too. Bye-bye.